Hey, Jonathan York, Bay Financial Partners, looking at the investment markets. Apple's results are really pretty good, and they sort of didn't quite save the market, but certainly saw a pretty major rally towards the end of last week, especially for the tech stocks that have been really pretty hammered over the last 3 to 4 days. Now, obviously, the reason for that, sell-off was the worry about inflation, and obviously the Fed coming to the party now and saying that, look, they are now looking to increase rates, and that could be as early as March this year. And that is the case, then potentially there's 4 rate hikes this year, and that will just be interesting to see how that sort of plays through. Now, is this going to be a question of when and not if the Fed tighten rates? That'll be the first tightening since 2018. Although it could sort of be argued that with the 10-year at sort of 185 now on its yield, potentially those sort of 4 rate hikes are already priced into the market. Now, obviously, that's against the backdrop of COVID and Omicron sort of sweeping through the US. It appears that that is starting to plateau, in cases are starting to fall just a little bit now. But you've still got the issue in the US where, certainly from the December data, you got around 4.6 million more jobs than the unemployed. So you still don't have enough people out there to take up the job vacancies that are there. And obviously, if you're trying to grow the economy and increase the growth, if you haven't got the people to take up the jobs, that's pretty hard. But the sort of great resignation is not just a US phenomenon, it's pretty much a global phenomenon. But again, overall, the US economy still looks in pretty good shape. Growth is reasonable. It's just going to be interesting to see the jobs data at the end of this week, just to see what sort of state the jobs market's in. Also in the US as well, sort of simmering in the background, you've got midterm elections this November, and it's going to be very interesting to see how the Democrats perform in that, because certainly at present they're struggling, and it looks like the Republicans might get at least the Senate back, if not the House. Now, one of the causes of the inflation push globally has been energy costs, as oil is well above $80 a barrel now. Firstly on supply, but also as well on the sort of political tensions in Ukraine, between Ukraine and Russia. Russia's Putin is trying to argue that the NATO is ignoring its sort of claims and its issues and worries raised. But certainly at present, with 100,000 troops sitting on the border, it doesn't look like it's a friendly gesture. In the UK, Prime Minister Boris Johnson is really pretty much on a sort of life support after the latest revelations, the investigations into the Downing Street parties, which many were conducted while the rest of the country was still in COVID lockdown. But again, if you take that out of the equation, the UK economy still looks in pretty good shape, and should be set for some reasonable growth over the next sort of 6 to 9 months. In Europe, you've got the strange situation where the ECB is still the only major sort of central bank that is adopting sort of QE and still sort of supporting the economy. Now, while growth again is looking reasonable in the European nations, there's still no sign of a rate hike on the horizon yet. A little bit closer to home in Australia, and certainly the relaxation of restrictions, potentially opening up of the sort of borders and states is really having a reasonable impact on the economy. And certainly while you've seen cases increase with the Omicron outbreak, hospitalizations certainly haven't sort of swamped the health system over there, and indeed now are starting to sort of plateau. Because again, the global issue is that, with these lockdowns, it all costs money. It's all very well the government supporting, various sort of industries, etc., with sort of handouts and support payments, but it all has to be paid for somewhere. So the Australian government has obviously taken the view that it's better to sort of keep the economy moving, keep it open, and trying to sort of trade and work its way through that. And so far, it seems to be working. Now you compare that with New Zealand, you've got sort of fresh, the government outlining fresh sort of payment schemes and sort of support schemes, etc. That's all got to be paid for somewhere. And with the borders closed, obviously hospitality and tourism are really struggling. And the economy is okay-ish. We get a pretty major boost in support from the dairy sector that potentially will put in around 13 billion this year. But still further down the road, there look some pretty horrific numbers in terms of debt to GDP levels. Because certainly with the borders closed and still the issues with MIQ, that really has been a bit of a debacle. So on the positive front, house prices are still sort of holding some reasonable gains. Okay, they might start to slow down in terms of the actual pace of increase going forward, but they're still holding some reasonable gains going forward. But that will probably be severely tested if, as expected, the Reserve Bank increased rates in February, and then potentially you've got another 2 rate hikes this year as well. Because sort of looking back now with hindsight, the bottom for mortgage rates was probably 6 to 9 months ago. And with the increased restrictions now on sort of lending and new sort of criteria to meet, the banks are being a little bit more sort of selective in who they're giving loans to, etc. And it is becoming a little bit tougher out there to get mortgages through. Now all this is taking place against a backdrop of the inflation number that was 5.9%, which is the highest reading since 1990. Now, when you add Omicron into the mix as well, and really New Zealand is probably just at the start of that outbreak, potentially you've got a pretty tough next sort of 6 to 8 weeks. Because if you look at the global sort of modelling, potentially by sort of end of March, early April, Omicron should have sort of peaked, and then we'll start to sort of fall after those dates. Now, while it has been pretty tough out there for equities, it's really pretty important, especially for those KiwiSaver investors, that you're not sort of chopping and changing. You've got to remember KiwiSaver is a longer term investment. It's looking for retirement. So if you're sort of in your sort of mid 30s to 40s, you've still got 20 odd years before you're looking to access those funds. Now, for those investors that are looking for income, it's still pretty tough out there in the fixed interest environment. And if you are looking for income, there's plenty of alternatives available. Go to the website www.bayfinancialpartners.co.nz for lots of interesting articles. And we look forward to speaking to you soon.